Let's talk private credit, a sector that certainly benefited from high interest rates. Frank Delielli from MA Financial joins me now. So a floating rate benefits as interest rates rise. What are we going to see if central banks are slower to cut than expected, which is what I was just talking about with my last guest?
Thanks, Juliet. Look, I mean, there's two components, I think, to where private credit is at the moment. I think from an investor perspective, you're right. This asset class does benefit significantly from rate rises because it tends to be floating rate. As private and credit investors, what we're really doing is investing at a margin above the base rate. So higher interest rates mean that we can pay our investors more in this asset class, and that's a good thing for them. From a borrower perspective, of course, the reality is that if your interest rates go up, it actually makes your cash flow position tighter. And so I think there's a bit of a tale of two cities there, just to consider it from that perspective. Our view has been for a long time that the lower for longer interest rate environment that used to exist and people used to talk about was an aberration. And so you did have to underwrite your counterparties on the basis that they could service interest rates at a level which is kind of normal. And I think really, not dissimilar to what your prior guest was saying, we're probably in a normal environment now, whether there's plus or minus 50 basis points here or there. Counterparties are going to have to service debt at much higher levels for a period of time. I think it's an attractive time to be a lender while this adjustment does take place, and if you can be more senior in the capital structure and defensively positioned as that adjustment takes place.
Well, exactly, in terms of defensive positioning, but also trying to get, a return on investment as well. Can borrowers service rates if we do see them come in at higher levels?
Yeah, look, I mean, in private lending at the moment, the sort of returns that we're able to obtain on loans are in that 8 to 12% zip code, and that's a meaningful amount of income that has to be diverted to service debt. So I think anyone who doesn't recognize that is probably deluding themselves a little bit. It is harder at the moment for borrowers to service their debt, and that's why some of those things are important to kind of have in your underwriting criteria. That said, I'd say when you're making loans, you're the priority provider of capital in the capital structure, and so if we're lending to a company, it's probably typically in a 30 to 40% loan to value against that enterprise. If we're lending to against an asset, a series of assets or hard assets, that might be in the 50 to 60% loan to value kind of zip code. So even if we're charging a borrower, say 10%, the asset only needs to yield 3 or 4% if it's a kind of company, or if it's a hard asset, maybe 5 or 6% to actually service that debt. What's really happening in this difficulty, I think, if people have underwritten well, is not that borrowers won't be able to service their debt at all. It's that the cash flow of assets, be they companies or physical assets, is being diverted to service the priority creditors to be debt holders in this environment while we do have this period of adjustment, and actually away from equity. So I think that's really the story that's going to take play if we do see this higher level of interest rates be sustained for a little bit longer than people perhaps thought at the beginning of this year.
And what do you think are some of the winners and losers in this space as well, Frank?
Yeah, look, private credit started life, if you go back several decades, it was really the world of what I'd call the unbanked. It was lending to borrowers that sat outside of bank and traditional lender risk criteria. What's really changed in the last, say, 15 years and has made the asset class particularly attractive and sort of coincided with the capital that's flown into it is that it is no longer the world of the unbanked. What's happened is that the things that banks historically have been able to do because of regulation, because of structural changes in markets and other secular trends has narrowed. And what's happened is that private credit has gravitated more and more prime, if you will, more and more into the world of the banked or the formerly banked. And so it's a much higher grade type of borrower. And I think that's really what, where the winners will be. The winners are those capitalizing on this particular trend. That is stepping into the void where banks used to be able to provide a lending solution, but they can't. For those trying to really capture those really high teens, above equity style of returns, well into the mid-teens and so on in this asset class, that really means that you're focusing on non-performing loans, or perhaps an element of distress, or something that's a little bit funky. And you can earn really high returns there. You can earn private equity style returns, I guess, doing that. But it is quite a lot more risky, and it's also a much smaller market. So, I think that the attractive part of the market is capitalizing on that moderate return, 400 to 600 over base rates, where you can actually be a priority creditor to an asset that's high quality, that's resilient, that can perform through cycles, that has a reason for being, and where you can provide now a solution that banks no longer can provide, and you get to earn a real premium for doing that. So, it's really those players, I think, that will be the winners. And, there are going to be losers, of course. I mean, you need scale to participate in this game. You need to understand how to work out things when they don't go right. That's easier if you have scale as well, because it means that your problems, when they do occur, will be smaller. You can't get every loan right. So I think that's kind of what will play out. But, there's been some people calling for fears of a bubble in private credit, for example. And I don't think that those fears have really played out, especially as we've already seen the interest rate rising cycle and the asset classes continue to perform.